should be fearful when others are greedy and greedy when others are fearful. For value investors, it's advisable that they use the dips in market as points to acquire more of a quality stock, along with finding new opportunities for suitable investment. Talking about investment options, we're talking about investment funds. It says the higher a fund's expenses. When looking at investment funds, the higher a fund's expenses, the lower its returns. The more frequently a fund trades its stocks, the less it tends to earn. Highly volatile funds are likely to stay volatile, and funds with high past returns are unlikely to remain winners for long. Index funds are the best choice for individual investors. So we talk a bit about mutual funds, the most common form of investment funds. And he says its merits are that the managers are the biggest shareholders, they're cheap, they dare to be different, and they limit their clients. And when looking at a mutual fund, you can look at the fund's expenses, its riskiness, the reputation of its manager, and past performance. Here's Graham's checklist, and he would go through it by hand every time he looked into invest into any stock, each and every single time. And if you go through it, you'll realize it's the same as his principles being mentioned in the book. So he stayed true to what he preached. Some other tips he gives throughout the book is that you should keep a minimum of 25% in bonds for safety and maximum of 75% of total assets in stocks. Shouldn't invest only in a handful of stocks. Diversify, keep between 10 to 30. So 30 would be, between 10 to 30 would be a good number. You shouldn't also over diversify. It'll just thin out your potential returns. And certain red flags that should be raised are if you end up trading more than twice a year or spending more than an hour or two per month on your investments. He says that day trading carries extreme risk, so you should possibly avoid it. And IPOs or initial public offerings are frequently overpriced, as the financial institutions usually end up taking advantage of the initial prices, and by the time it's available to an average investor, it's probably overpriced. So again, treat junk bonds with skepticism, keep extreme caution while buying foreign bonds, as past records have shown, and annual operating expenses when dealing with foreign bonds should not be higher than 1.25%. A great company is not a great investment if you pay too much for the stock. The bigger firms get, the slower they grow. When price-earning ratios go above 25 to 30, then know that the risk is getting too high. And keep a lookout for temporary unpopularity, which enables you to buy a great company at a good price. Again, diversify your portfolio. And an additional comment from the commentary in the book is you should not let the ease and up to a minute feel of the internet seduce you into becoming a speculator. In the end, investment is most intelligent when it is most business-like. The market is not efficient, and you keep reason and long-term thinking over emotion and short-term impulses. So generally, value investing, you're looking for lower than average price to book or price to earning ratios and or high dividend yields. You don't just follow interpret, take advantage of depressive markets, and always have a margin of safety. And despite what most people would say, if you follow these rules as is shown by the market, the odds just might be in your favor. Thank you.